We're here, obviously, and a quick thank you for Tech Capital for hosting us, and obviously Jared for doing a fantastic job. This event gets better and better every year. I'll ask the team to introduce themselves in a second, but just maybe a quick introduction for myself. So I'm with HSBC, and so going to be very careful not to give any opinions. Here to be the chair rather than take questions. So if you've got questions for me specifically, then we'll do it afterwards. So I head up the TMT investment banking side for the UK, and that's a focus more broadly across digital infrastructure and anything in the innovation economy. So post our acquisition of Silicon Valley Bank last year, we've kind of broadened our reach quite substantially. But infrastructure and the digital infrastructure support is one of our main areas globally. So earlier this morning on one of the previous panels, Bruno talked about the significant demands being placed on national infrastructure grids. Obviously that's got geographic and political implications, and we're going to come and touch on that. But Olivier also talked about investor speculation on taking up reservations. And I thought there were some quite interesting angles there. Power supply is obviously an exceptional geographic issue. I was interested to hear they've got too much in Brazil, so that was very interesting this morning. It's the first I've ever heard of that. But we're going to try and address some of those topics today. So some of the things that we've all been talking about as we've built up to this event are tensions around access to compute and environmental concerns, increasing focus on investment in renewable sources. We saw Brookfield and Microsoft with a 10.5 gigawatt pact to support each other. Obviously impacts on base load with renewable power only being available obviously when the sun's out and the wind's blowing. Supply chain issues, big geopolitical impact there. Movement of manufacturing plants out of certain regions into other regions. And then obviously building where capacity is potentially needed in a less centralized way. And all of that underpinned by AI. So with that, maybe pass on to the panel to introduce themselves, and maybe work from the far end down, and then we can move into some questions.
Sure. Thank you. Very nice to see everyone here today. Gonçalo Bernardo, I'm an investment partner with Pallister. I spent around 11 years with Morgan Stanley and was an investment banker around the world. Then I spent 5 years with OMERS Infrastructure, one of the Canadian pension plans in their direct infrastructure arm, and I was responsible for digital infrastructure in the Americas. I spent a bit of time as an entrepreneur, and more recently, about a year and a half ago, I joined Pallister. I was a digital infrastructure specialist fund based out of New York, but investing kind of around the world with a focus in North America and Europe.
Morning, everyone. My name is PJ. I've been a TMT banker for over 25 years, and at Guggenheim, we run one of the leading financial advisors to the digital infrastructure ecosystem, and we have a particularly strong franchise in data centers. I mean, to give you an idea, in the last 12 months or so, we helped Compass on the sale to Compass Data Centers on the sale to Brookfield. We worked with Cyxtera, also on a successful transaction post-restructuring, which culminated in a transaction with Brookfield. Earlier this week, we helped Ethics Everywhere here in Europe with bringing in a co-control investor, Infinity, into the capital structure, and actually a secondary exit for the original kind of backer. So very active across the data center ecosystem, both North America and Europe at Guggenheim.
Hello everyone, very nice to be here. Mike Hollins, I've recently joined Columbia Capital. Columbia invest in companies at the inception stage and take them from a management team with no assets to significant platforms. Names you may be familiar with in this space include Cologix, Terraco in South Africa, EU Networks, Zayo, all companies that Columbia Capital have been involved with. I myself, like I said, joined 2 months ago. I was previously, had a career in the data center space and telecoms. I was with Digital Realty for many years, focusing on entry into new markets, and prior to that with Interaction, and then in the telco space before I joined the data center space.
Good morning. Nice to be here. My name is Matthew Baines. I'm from Schneider Electric. Schneider is a global technology vendor and sustainability and energy management solution provider. I've been there for 25 years. I'm the VP of Strategic Partnerships within our global cloud and co-location segment. So collaborating with the ecosystem that sort of surrounds and influence all of the big end users, end user being a hyperscale or co-location, let's say. So all of the, let's say, the design and construction partners and our alliances that we work on with maybe real estate, maybe private equity as well, of course, and the likes of NVIDIA, and what we're doing with these organizations to help and support them around the world with their investments, their assets, and how we can work together to support the growth that we are seeing in the industry. Thank you.
Thanks, everyone. So we'll move on to some questions for the panel. Mike, why don't we start with you in relation to our title, which is around geopolitical tensions. So how are geopolitical tensions influencing your investment strategies, specifically with respect to strategic site selection and geographic priorities?
Okay, well, I think the first point to make on this topic is that investment in digital infrastructure is for the long term. Whether it's subsea cables, data center campuses, power infrastructure, mobile, we're looking at the long term, and geopolitical tensions have to be put in that context, and that we don't get swayed one way or incorrectly because of what might be short-term geopolitical tensions, but we pay attention to the ones that are going to be longer term. Perhaps if I give some examples of what I mean. If we look at the number of subsea cables that are planned to land in China in the coming years, because of the decoupling of the US and Chinese economies, that's fallen off a cliff. So whereas previously Hong Kong might have been a hub that we expected to see continue to grow and develop, we're seeing a break on that. Underlying the underlying trends beneath that are that the industry was always looking to diversify and get other locations. And so this is a geopolitical issue that has accelerated what an engineer might have wanted anyway, which is diversity into other locations such as the Philippines or Indonesia. A more robust and diverse digital infrastructure in a region is what one would design if one was starting from scratch. So the geopolitical issue has to be put into that context. Here's something that's happening that the industry is benefiting from, and it's accelerated, and it's not a problematic issue. The other example might be what we've seen happen in the Red Sea recently, with a number of subsea cables cut because of a ship that dragged its anchor that had been hit by the Houthi rebels. So 3 key subsea cables were cut, and this has really put, underlined in the industry the need for diversity, for not relying on one route too much for the flow of traffic. The industry had already been looking at other routes to complement the Red Sea route, so overland into, say, via Jordan, for example. And this is the perspective that we take, that if the geopolitical issue is actually helping accelerate what the industry needed anyway, then it's like a positive. If the geopolitical issue is causing the industry to stop and not progress, that's the where we see the problem. So in summary, we're in a long-term business, and we've got to understand what the impact of these geopolitical issues are having, whether they're just short-term or going to be around for the long term.
And if I may add, I think one interesting thing that we're seeing as a result of the geopolitical tensions is a shift from, and particularly I think COVID taught us a lot of lessons, was a great driver for a lot of the digital infrastructure assets because it again just drove up demand. But ultimately it also put the pressure into supply chains, and it created two really important points. One is the governments figured out how much they rely on digital infrastructure, and two, the governments also figured out that how little control they have over it. So fundamentally what we're seeing is a shift, and again I think digital infrastructure is just probably one extreme example, but we are seeing a shift from globalization to actually kind of regional location of some of these assets. So topics like data sovereignty that 5-6 years ago were not really kind of top of mind for everyone, right now have their own panel in this conference. Right, so we're starting to see kind of business models evolve. You're starting to see things like the CHIPS Act in the US, where they're trying to build manufacturing. Bloomberg yesterday had an article on what happens if Taiwan gets involved to the chip manufacturers. So all these topics were not top of mind 5 or 6 years ago, and now they are. Now that creates kind of sends us backwards in terms of what digital infrastructure is, because to the point that was being made, we're going to a world where there will be a lot more duplication. Because people need that extra security, people need the backup plan, people need to understand that hopefully the next COVID doesn't come, but if it does come, they have some control over their digital infrastructure, because it became such a crucial part of everyone's life. So I think those geopolitical tensions are really kind of have been a trigger effect for all these factors that ultimately we're going to see over the next 10 years, and if anything, have only been aggravated by AI and by the importance that AI might have in the future. So I think digital is going to go through a period where you're going to see this duplication, but you're going to see a lot of localization of infrastructure and a lot of decentralization of infrastructure, and that's supply chain.
Maybe to challenge a little bit what Gonzalo said, and because if you do look back when public cloud started, in Europe we did have kind of a reaction to that, very much focused around kind of the creation of national cloud initiatives. I mean, if you remember, in France you had Thales and Orange. In Germany there was a similar kind of cloud initiative. There was then the European cloud initiative to really try and at least give a European response to the advent of the hyperscalers that dominate and still dominate the public cloud industry. A different debate in the context of AI, but that wasn't successful. I don't know what others think, and Matthew, what do you think? But I think the kind of the European national cloud alternative, owned and run by European investors and on European infrastructure, ultimately compromised in some form of kind of hybrid solution, where ultimately Amazon and Microsoft were the kind of the key biggest suppliers. And yes, although there was regulatory protections, these assets were still very much embedded in the kind of the technological ecosystem that is very much US public cloud ecosystem. And those European champions, like for example OVH Cloud, which was positioning itself 5-6 years ago, never became a real alternative. And that's simply because in public cloud, scale matters, and you just having tens of thousands of servers is not enough, because you need millions of servers to really make the cloud function.
Absolutely, and I think that's very fair, and to that point, a lot of those didn't take off. But ultimately, you're going to go into the debate, which is, what is a national cloud? Is a national cloud an Amazon server in a European country? Does that qualify as national? Or is a national cloud do you need a national champion? And I think, to your point, one of the reasons it probably didn't take off a few years ago was exactly that you needed scale, you were fighting in a competitive market, there was some regulation but not enough. Effectively, you're going back into the so-called walled gardens where people kind of really need to create the stimulus to develop the local infrastructure and the local champions, if they need to be local champions or the international champions with kind of a local footprint. Again, the US has plenty of examples of things like that going on right now, and I think Europe is starting to have more and more of those. So I think it'll be a very interesting kind of couple of years, and I think for us as investors and as advisors to investors, I think, and the suppliers to some of the investors, will be very interesting to really understand where, to your point, which of these models are actually going to succeed. So a lot of our concern is we got to react to the geotensions and kind of to where the market is shaping because of those, but at the same time we got to make sure our investments are safe. So we don't want to invest in a European cloud if we don't think they're right, or an European champion for a cloud if we don't think the right characteristics for it to survive and thrive are there. And a few years ago we didn't think they were, and kind of right now it feels like, particularly again because of AI, the pressure is on to create those conditions and those barriers for other people to compete in.
So just to pick on some of the topics that came up there, and you had me thinking about the fact that actually a lot of this has been going on for a very, very long time. At the risk of aging myself, I did a project a long, long time ago for the Hong Kong government on how to make Hong Kong the internet hub for Asia. And a lot of that was around subsea cable capacity, network infrastructure, building data centers. But it was very kind of nation specific at the time. It wasn't about kind of cooperating, it was about competing. One of the topics you discussed there was kind of localization, essentially a spread of capacity, not least because of potential constraints, but that's also going to weigh into the supply chain, which we've picked up on. And so Matt, I wouldn't mind if you could opine slightly on the supply chain issues that you see, because no doubt you're at the center of a lot of these debates.
Yeah, and just to comment on your topic, PJ, yeah, I think just cloud, whether we have a European-based cloud, or I'll come on to that one second. I think it's scale. I agree with you, it's scale. We all talk to you all in the investment community. Just the casual conversations I've had there is the big private equity guys where they're investing. Number one thing, if the underpinning tenant is a Microsoft or Amazon, that box is ticked straight away, and they can move on with the rest of it. So I think versus a European cloud, I think they're little shakier maybe, and a little bit more cautious. On supply chain, you touched on some things and disruptions we've had as Schneider, as a global technology vendor, manufacturer. It's been a rough few years, a tough few years, not rough, actually it's very good, but post-COVID was the tough time in terms of supply chain availability of components for us. This was before the big spike in, let's say, the huge spike we've had in demand. It was difficult, so we had to diversify from that regard. Post-COVID, we had to look at our supply chain, our strategy. We had some single source. We got rid of that, of course. That caused the whole industry a lot of problems, actually. Just some small things, maybe fans or something like that. Just silly, really. And I think we've changed our strategy there. We've also decentralized. I think you mentioned that a lot. We had a lot of centralized manufacturing, which does bring efficiencies for sure. When you touch on geopolitical, or even the blockage that we had in that region that you're talking about for the grounded, we need to diversify our manufacturing and not have it coming from one source and one route on one boat. So we've created a bit of a hub model within Schneider now. So we have regional hubs from a business perspective. We couple that to make decisions regionally. This is a lot of post-COVID, but it's also a strategy of ours generally. But we couple that with manufacturing as well. So we are moving a lot of manufacturing to zone level, so we can service zonal customers, clients, and demand from within that zone. We're not relying necessarily on global manufacturing from one or maybe two locations. So we're definitely doing that as an organisation. And then I'll be brief. Just lastly on supply. We as Schneider, as our peers are, we're challenged. It's very difficult at the moment. It's a good problem to have, of course. This zoning and this hub model also helps with speed to market, of course, as well. But generally, and Olivier was saying it earlier, he said, well, technology vendors, they service their biggest customers first. That's sort of something we have to deal with. It's not really like that. We have to service the whole market. But what let's say the larger customers are good at, and they have the ability to do and execute, is capacity framework agreements with people like us. 2, 3, 5 years ahead we're looking at now. So they're very good at that. They have the wherewithal, the will, and the financial investment to do that. Or they're asking us to stand up dedicated manufacturing plants for them, which in theory would not impact any of the rest of the supply chain. It takes a while to do that, but that's also what we are doing with a few of the larger customers that we face. So it's a very dynamic market at the moment.
Could I sort of chime in on this supply issue that you've been discussing there, Matthew? We've seen some projects really demonstrate how the supply issue plays into the timeliness and cost effectiveness of bringing digital infrastructure to the market. Some countries, maybe surprisingly, have sorted out this supply chain issue, and we've seen, for example, in India, data center projects come in on time and on budget because of the structure of the supply chain, whereas other countries are going to be very dependent on solutions such as the one that Hark in the opening address this morning from Infra Partners talked about, where there isn't the capability in the country to deliver what's needed in a timely manner, and having infrastructure built off-site and then shipped to the location and constructed on site or put together in the relevant country is going to be a very interesting solution, although that also has challenges to overcome. Can that be done costly, especially if there are import duties and taxes to be applied? Will the market be able to accommodate increased prices that will be demanded if the cost base goes up? But supply chain is having this huge impact on different countries' ability to bring investments to market on time and under budget.
And what I would say is that, to add on, what I think is interesting, and again, we've seen this happen in several different industries, like it's happening right now, is you're always looking to what is going to break next in the supply chain. What is the piece of the equipment that now has a very long lead time? What is the piece of the equipment that for some reason isn't getting produced? I think the interesting thing we found is there's not that many suppliers, particularly if you look at things like data centers. There's not that many suppliers. There's not that many suppliers that the banks will sign off and say, this is a good supplier, you're good to go on this. So your number of alternatives is somewhat limited. And at the same time, a lot of those suppliers are in bigger companies that have gone through similar cycles. So it's very interesting when you look, for instance, at some of the projections you see from the suppliers and some of the projections you see from the industry, and a couple of the people in the previous panel were talking about how much capital needs to go out the door and everything else. The suppliers are actually tend to be a little bit more conservative than the industry is, and it does feel like there will be some, again, in some solutions that are being built, like you're building a custom factory for someone who's got a gigawatt worth of data centers or something else. But it does feel that there are a couple of the suppliers, at least, that are taking a more cautious approach and saying, hey, if I build all this capacity and supply all of this, if this demand doesn't last the next 10 years, then all of a sudden I have a problem in 5 years. And so it does feel like the market's going to be at least a little bit tense for a while. And also, let's not forget that supply that just doesn't turn on and off like that. So you need to train people, you need to build facilities, you need technology, and you're putting a lot of pressure on the whole system. So it kind of feels like we're in unless the demand market softens, feels like we're in a tight market for the near future.
I think one particular issue around the availability of of suppliers, or the lack of diversity of suppliers, that I think is very, very important from a geopolitical perspective, is the availability of the advanced AI chipsets you need to power ultimately all the applications that we're talking about, and that is really kind of critical to the implementation of AI around the world. And I think that's becoming a geopolitical tool. If your only supplier is NVIDIA, we've got, 80% market share, but by far they've got the most advanced chipset. So if you really want to be competitive as an economy, you need to have access to those chipsets. Then who decides who is in front of the queue? And I think it was touched upon yesterday. Obviously, the hyperscalers benefit from that, and I think they own the largest applications there, whether that's OpenAI owned by Microsoft or DeepMind owned by Google, etc. But from a geopolitical perspective, and also kind of touching upon the let's call it the rivalry between Washington and Beijing, some big decisions are being made. I mean, are we going to make those advanced AI chipsets available to China? The US government says no. And obviously that is putting the likes of Tencent and Alibaba on the back foot. So they need to think about how do we develop our own AI chips that is competitive. Because ultimately the competitiveness of the economy, the competitiveness of the military depends on implementing AI as a solution. And I think that's, I mean, it's a shame we don't have Alan Kearns here to comment on kind of last week's announcement by Rishi Sunak, very much supporting CoreWeave, spending $1 billion in the UK economy, building data center infrastructure, supporting the likes of Waves that does AI automotive software development, and having the UK as a headquarter, European headquarter for a lot of those AI technologies and AI companies. Because I think, again, going back to the supply chain, the importance of ultimately unlocking NVIDIA and having the access to the H100s that you need is going to be politically very important. And clearly, again, that's where I think the US is better positioned than we are in Europe.
And I think the point, and I 100% agree with you. I heard someone say the NVIDIA market share was even higher than 80, it was 90%. I think the interesting thing is, which adds a little bit to kind of where the power is shifting, is the market share you don't see. So when you look at the chips that are produced in-house, or for instance, to give you even a more obvious example, when we look, for instance, at liquid cooling, and everyone talking about AI, and AI needs to shift to liquid cooling and all these things. Effectively, when you talk to the data center providers, most of them are actually not providing liquid cooling in most of their facilities, or if they are, there's kind of trial, no one's got a standard for it, no one's really got a straight up solution for any of these things. So what's happened is all the stuff's getting done in-house. So there was an article, I think, that Google's producing almost as many, not as many, but kind of 70 or 80% as many chips as NVIDIA on their own designs. Microsoft's got their own chip designs. Meta's doing all of them. Funny enough, some of them are using the same suppliers as NVIDIA, so there's still a supply concentration and a lack of supplier diversification. But ultimately, those very big companies also have an edge and are starting to play a key political role, and they are having to kind of take decisions based on geopolitical tensions. I guess the most obvious example is one around Starlink and Elon Musk, or even GPS and some of the, and you've seen this play out in the most recent conflict. So you're, to PJ's point, you're seeing kind of digital infrastructure front and center, and kind of as a bargaining chip in a lot of these things, and even as a crucial point in some of these conflicts. So it's, I think we could kind of see it, but not really forecast it a couple of years ago. And now again, the aggravation of these tensions has really brought this to the front line. And I think it's discussions that are going to happen more and more. And again, you've got examples around the world where carriers are forced to strip out telecom equipment because of political tension. So if anything, the last years have taught us is that you've got plenty of examples why digital infrastructure is kind of a core part and is core of the competitive advantage, and the supply chain that provides for it is another one, is becoming a success factor for economies.
So let me try and bring a few of those threads together with my final question. So digital infrastructure is growing enormously. I think we all agree with that. There's supply chain constraint. There's a kind of nationalistic fervor. There's regionalization, localization, building manufacturing plants specific to clients, need for more subsea capacity, need for more network, need for more compute, need for more chips, et cetera, et cetera, et cetera. All of that obviously needs funding. So the people who are writing the checks, the investors out there, they've been writing checks for decades gone past. And some of these facilities, networks that are needing to be redeveloped, not least the investment in potentially brand new sites, brand new data centers, are requiring new and bigger checkbooks quite often. But the previous investments are also still delivering a return, some of which may not have delivered a return yet. So to pose my question, how are you seeing the kind of ROIC requirements of historic investors being replaced with new investment, and the impact that has on both, well, not both, but all of those issues. So supply chain issues all the way through, from chips through to capacity.
So I can start. I think ultimately we're in a scarce market. So having access to power, having a facility that's connected, having the ability, it's a lot faster to kind of, maybe not perfect, but to refurbish something than it is to build and license something from scratch, particularly if you think about the wait time to connect to the grid and several of the other factors. So what I would say is, ultimately, if the returns don't work, people are not going to put the capital in to do that. But you're in a scarce market where people are trying to secure capacity. The same way they're concerned about chips, they're concerned about the power. So you're seeing deals getting done further and further ahead. It started being 1, 2, 3 years out. Now people are going further out. You see kind of some people saying, hey, we want to develop X capacity over the next 10 years, and maybe we do a reservation, maybe we do something. So what I would say is, ultimately the price has got to work. And the price has got to work with all those things, with the supply chain, with the chips, with everything else. And so as we see these things kind of getting further out, what I would say is, if you want to refurbish an existing facility, the price has got to be there to kind of make the return worth the additional investment. And because there is not a lot of available capacity in most markets, the price normally is there. And the price, I think I would say one point further, which is the price is shifting to where a point where a few years ago you were signing a closed envelope to people and saying, here's the price, come hell or high water, I'm going to stand to it. And because you're my biggest client, I'll never move the price because I'm concerned about the next contract, to people, some people kind of saying, you know what, this is the price, but I'm not able to secure the set, so I might need to fluctuate the price a little bit. So going back to your point, yes, refurbishment will happen, I think, in the short term, and while the market is kind of short capacity, that's not an issue because the prices paid will have to justify it. When the market is long capacity, then you're going to have a big concern. But I think in most cases, and for the larger assets, they're contracted 10 to 15 years out. And 6 years ago, I couldn't have forecasted COVID or AI coming in as fast or overnight as it did. So 15 years from now, I think it's going to be a whole new ballgame. I was talking to someone about nuclear and basically how you can create energy from nothing yesterday. So if that happens, it's a whole new game, and you got 15 years to figure it out.
I think, although I would love to agree with Gonzalo, and especially not just for the argument, but also from a sustainability and recycling perspective, and ESG perspective, I mean, in theory, it should make sense to look at an existing facility and bring down the PUE and ultimately have a much more efficient, future-proof proposition. When we're in the market selling assets that are state-of-the-art, modular, and future-proof, and in the market with, let's call it your telco data centers that have been built 15, 20 years ago and are not fit for purpose, don't have the power density, don't necessarily have the structural readiness. I think retrofitting and existing facilities is really, really hard. and it's much easier just to, it's a bit like refurbishing a house. It looks great to keep the facade and start all over again. Change the plumbing. I think in the data center there's a lot of plumbing. Plumbing is very expensive. If you want to implement liquid cooling in an existing kind of box or shell, I mean that has been operating on other technologies. I think it's very hard because also it needs structural reinforcements, and the cost of that just outweighs the benefit of starting from scratch. So I think the future is I mean the designs are changing. They're changing significantly. They're becoming more modular so that you can almost anticipate the future capacity needs. If you're in a country where AI adoption is not as high or demand is not that, at least you build that in, so you have that kind of space requirement and power density requirement for AI. But it's I think from an investor perspective, these assets that are built 10, 15, 20 years ago and are not ready and not future-proof from a power density, let alone from a cooling perspective, don't have that kind of the substation capacity to increase significantly, don't have the proximity that is so important. They risk becoming a little bit of stranded assets. And yeah, of course there will be a few exceptions where for historical reasons, because of location, it's just very hard to rip it out, and they continue to have continue to be a nice cash cow, and the capex that's put in the building is relatively limited. But that at some point will migrate to kind of new state-of-the-art facilities.
There's a different price.
There's one chance for one final point from somebody. So
One each.
one
Okay.
each. Go on quickly.
Go for it.
There was a lot that JP that said that points that I wanted to make, so it's good we haven't got time to repeat them. But what I would say is that all this discussion that we're having is very focused on AI, and there's other parts of the digital infrastructure ecosystem that require and continue to require a lot of attention. And some of that is perfectly okay to refurbish and enhance.
I agree. I think the next however many gigawatts, you can read lots of reports, the next 10 years, or the next 5 years, 4 years, let's say, I think 20% of the demand will be AI. So you're right, this cloud is huge as well. On existing sites, I think it's all about the money and what application is on that site, whether it is existing cloud or enterprise or retail, depends on what return you're getting on the leases, of course. But just lastly, I think I'm on the board of the EU DCA as well. I think what's important is these data centers, they need to be brought up to standards as well for the new regulations that are coming. That's a challenge, and again, the money has to work there to meet the demands of the legislation, not just new technology for modernization of life cycle refresh, but the whole data center needs to be in line with whatever's coming down at 2030 in Europe, for example, and elsewhere. So it has to work.
I wouldn't have expected Schneider to not vote for redevelopment of sites.
No.
So look, I just want to wrap it up now. If there are any questions, let's try and grab them outside over coffee. But quick thank you to Gonzalo, PJ, Mike and Matt. Thank you very much.
Thank you.